Good morning, good afternoon, and good evening. Today we will talk about Chapter 11, Part 2. Like and subscribe, I will be much appreciated. How well have factor tilts worked in practice? Mutual funds and exchange-traded funds are available that allow investors to implement each of the smart beta strategies considered above. Here we will examine the actual records of some of the funds and ETFs that mimic each of the four major strategies, portfolio flavors or tilts, that have been advocated, as well as some that employ blended flavors. Information about each of the funds or ETFs listed can be found in the Random Walker's address book included as an appendix. Value and size tilts mutual fund and ETF portfolios. The strongest academic evidence supporting smart beta portfolios is the tendency of value stocks to outperform growth stocks and the tendency of small cap portfolios to outperform large cap ones. Here is where the academic literature is unambiguously supportive. But we must remember that the results of published studies, even those done over decades, may still be time dependent, and we must ask whether the return patterns of academic studies can actually be generated with real money. The chart that follows presents average actual returns generated by mutual funds classified by either their growth or their value objectives. Value funds are so classified if they buy stocks with low P multiples and low P/BV ratios. We see that over a period going back to the 1930s, it does not appear that investors could actually have realized higher rates of return from mutual funds specializing in value stocks. Indeed, the chart suggests that the period studied by Fama and French from the early 1960s, demonstrating a strong value effect, may have been a unique period in which value stocks rather consistently produced higher rates of return. The top chart on the next page was compiled from the records of actively managed funds. For more recent periods, we can repeat the analysis with smart beta indexed ETFs, which now exist. The bottom chart shows the exact same pattern repeated with indexed ETF portfolios that were available during the 10 years from 2004 to 2013. Investors looking for a decade of outperformance with value ETFs would have been disappointed. Neither the mutual funds nor the ETFs with a value mandate would have produced above-average returns. The chart shows the return of value mutual funds divided by the return of growth mutual funds. A number above, below, 1 indicates that value is outperforming, underperforming growth. Source: Bogle Research Institute. The chart shows the return of value mutual funds, value ETF, divided by the return of growth mutual funds, growth ETF. A number above, below, 1 indicates that value is outperforming, underperforming growth. Source: Bogle Research Institute. A somewhat similar story can be told about the small cap effect. The long-run tendency for investment in smaller firms is to produce higher rates of return than investments in larger companies. There has been substantial volatility in the relative returns of small-cap and large-cap portfolios. For example, the chart below shows the 30-year history of the Russell 2000 Small Cap Index and the Russell 1000 Large Cap Index containing the 1,000 largest companies in the market. Note that the 30-year returns are almost identical for the two indexes, and there is no evidence of consistent outperformance of either index. Data over the 10-year period from 2004 to 2014, when investable ETFs have been available for the Russell 1000, ticker IWB, and 2000, ticker IMB, indexes, also show considerable reversion to the mean, although smaller companies have produced average annual returns almost 1 percentage point greater than the returns for larger companies during this period. Russell 2000 average annual return, since April 2, 1984 8.31%. Russell 1000 average annual return, since April 2, 1984 8.78%. IWM 2000 average annual return, since April 1, 2004 8.07%, IWB 1000 average annual return since April 1, 2004 7.97%. The chart shows the returns of the Russell 2000 Index, ETF, divided by the returns of the Russell 1000 Index, ETF. A number below 1 indicates that the Russell 2000 is underperforming, the Russell 1000. Source: Morningstar. Blended hybrid strategies. We have called blended strategies those that depart indirectly from capitalization weighting in an attempt to benefit from the factor tilts of value and size that have figured prominently in the academic literature. The two principal strategies are those of equal weighting and the research affiliates fundamental index TM. Both give the portfolio a small size and value tilt. The Dimensional Fund Advisors (DFA) portfolios. DFA funds have experienced somewhat better performance than many of the other smart beta offerings available to investors. They are generally low cost with expense ratios only moderately higher than the fees of broad-based capitalization-weighted ETFs. However, they are sold only through investment advisors. The investment advisors from whom DFA funds are available are fee-only, that is, they do not collect extra commissions for placing investors in particular funds. Thus, these advisors tend to be unconflicted, unlike other advisors. Nevertheless, they charge advisory fees that could range up to 1% or more, and therefore the extra returns that have been available from many DFA funds need to be reduced by these advisory fees. Do-it-yourself investors who do not need the hand-holding services of an advisor can avoid this substantial extra layer of costs by buying standard index funds. On page 278 we show the performance of two DFA funds over a 10-year period ending in April 2014. Note that both the DFA Small Cap Value Fund, ticker DFSVX, and the Large Cap Value Fund, ticker DFLVX, have outperformed their benchmarks by over 1 percentage point. Again, however, we need to emphasize that DFA is quite explicit that any extra returns represent an appropriate compensation for the added risk of the portfolios. Note also that the DFA funds, like all the smart beta funds, experience periods of underperformance. DFLVX benchmark, IWD DFSVX benchmark, IWN DFA Large Cap Value Annual Return, since April 1, 2004 8.92% Russell 1000 Value Annual Return, since April 1, 2004 7.65% DFA Small Cap Value Annual Return, since April 1, 2004 9.12% Russell 2000 Value Annual Return, since April 1, 2004 7.49%. The chart shows the return of the smart beta strategy divided by the return of the benchmark index. A number below 1 indicates that the smart beta fund is underperforming the benchmark index. Source: Morningstar. Research affiliates Fundamental Index TM, RAFI. By the criterion of commercial success, the RAFI smart beta funds are among the most impressive of all the new fund offerings. The founder of Research Affiliates, Robert Arnott, is able to hold audiences spellbound as he argues that cap weighting implies that holders of such portfolios will always be holding too big a share of overpriced growth stocks. He avoids this problem by holding too big a share of overpriced growth stocks. He avoids this problem by adjusting the weight of each stock to its economic footprint, such as earnings, assets, and the like. Of course, this weighting gives the RAFI portfolios a tilt toward value and small size. As of the start of 2014, Research Affiliates managed $1.66 billion of assets. The RAFI ETF, ticker PRF, has indeed outperformed its benchmark, the Russell 1000 Index, by about 1 percentage point over its 7-year history to early 2014. Research Affiliates claims the excess return results from its avoidance of the overpriced stocks in the benchmark that have higher market capitalizations than are justified by fundamental valuation metrics. An analysis of the RAFI's results suggests, however, that the excess performance results from the assumption of higher risk. The chart below shows the quarterly excess return of the RAFI portfolio, PRF, over its benchmark portfolio, the Russell 1000 Index, ETF IWB. The chart indicates that there are usually small quarterly differences over time that are more likely to represent underperformance by RAFI rather than excess performance. There is, however, one notable exception during 2009 when PRF delivered extraordinary excess returns that were entirely responsible for the 7-year RAFI excess return. Fundamental Index Average Annual Return, since December 19, 2005 8.77%. Russell 1000 Average Annual Return, since December 19, 2005 7.71%. Equal Weight Average Annual Return, since December 3, 2010 16.44%. Russell 1000 Average Annual Return, since December 3, 2010 16.23%. The chart shows the return of the Smart Beta strategy divided by the return of the benchmark index. A number above, below, 1 indicates that the Smart Beta fund is underperforming the benchmark index. Source: Morningstar. The RAFI portfolio substantially overweight large bank stocks in 2009, coming out of the financial crisis, since these stocks sold at unusually large discounts from their book asset values. As mentioned above, the RAFI Fundamental Index TM portfolio had about 15% of its portfolio in 2 stocks, Citigroup and Bank of America, at that time. It turned out that such an overweighting helped produce excellent returns. But it was far from clear at the time that the troubled banks would avoid nationalization. In any event, the strategy involved considerable risk. It is hard to avoid the conclusion that whatever success RAFI has had in generating excess returns resulted from the assumption of greater risk rather than from the mispricing of growth stocks. A statistical analysis of the RAFI results also supports the risk explanation. If one performs a statistical analysis of the PRF's returns, explaining them via the Fama-French 3-factor risk model, where value and size are considered risk factors, the RAFI excess performance, its alpha, is estimated to be 0. The performance chart also indicates long periods of underperformance during the history of the ETF. Equally weighted portfolio strategies. As was shown for the RAFI ETF, equally weighted portfolios have delivered somewhat similar returns. We can illustrate the performance of these portfolios with the Guggenheim Equal Weight 1000 ETF, ticker symbol EWRI, compared with its benchmark, the Russell 1000 Capitalization Weighted ETF, ticker IWB. A short 3-year history is shown in the chart on page 279. Again, we see alternating periods of overperformance and underperformance, with equal weighting producing a slightly larger average annual return. Of course, the 2 portfolios do not have the same characteristics. Equally weighted portfolios give far greater weight to the smallest companies and hence have diversification and risk characteristics quite different from those of capitalization-weighted portfolios. They are also tax inefficient, as indicated earlier. Other factor tilts smart beta portfolios have attempted to exploit the tendency for low volatility strategies to provide attractive returns and for stock returns to exhibit momentum over time. A variety of ETFs are now trading that give investors the opportunity to put real money to work in these strategies, so we can analyze their performance as well. Here the results are not as good. Low beta, low volatility strategies. Several ETFs are marketed that attempt to provide investors with practical instruments designed to take advantage of the attractive returns from low volatility stocks. The ETFs differ somewhat in the specific strategies employed and in the benchmarks against which they should be measured. The SPDR Russell 1000 Low Volatility ETF, ticker LGLV, has been available only since early 2013. But the Power Shares S&P 500 Low Volatility ETF, ticker SPLV, and the iShares MSCI USA Minimum Volatility ETF, ticker USMV, have been available since 2011. None of the three ETFs have produced returns that have exceeded their capitalization-weighted benchmarks through the first quarter of 2014. Momentum strategies. The Acure Momentum Fund Class L ETF, ticker symbol AMOMS, has a longer history, having been available since 2009. Over its life through the first half of 2014, the ETF has failed to produce excess returns over either the Russell 1000 capitalization-weighted ETF or the Russell 1000 Growth ETF. While the time period for the low beta and momentum ETFs is too short for definitive conclusions to be drawn, it is fair to say that thus far neither strategy has demonstrated superiority when the portfolios have been run with real money. Real money portfolios do not in general demonstrate the kind of effectiveness shown in academic simulations. Low volatility average annual return, since May 5, 2011 14.59% Russell 1000 average annual return, since May 5, 2011 15.29% Momentum average annual return, since July 9, 2009 19.54% Russell 1000 average annual return, since July 9, 2009 19.99%. The chart shows the return of the Smart Beta strategy divided by the return of the benchmark index. A number above, below, 1 indicates that the Smart Beta fund is underperforming the benchmark index. Source: Morningstar. Implications for investors: Smart Beta strategies rely on a type of active management. They do not try to select individual stocks but rather tilt the portfolio toward various characteristics that have historically appeared to generate larger than market returns. In their favor, the Smart Beta portfolios provide these factor tilts at expense ratios that are lower than those charged by traditional active managers. In general, the records of Smart Beta funds and ETFs have been spotty. Many Smart Beta ETFs have failed to produce reliable excess returns, although a few have beaten the market over the lifetime of the funds. These funds are, however, less tax efficient than capitalization-weighted funds that do not require rebalancing. To the extent that some Smart Beta strategies have generated greater than market returns, those excess returns should be interpreted as a reward for assuming extra risk. In departing from the market portfolio, investors are taking on a different set of risks. Smart Beta portfolios do not represent a sophisticated better mousetrap for investors. Investors should be wary of getting caught in the riskier mousetrap themselves. Smart Beta portfolios have been the object of considerable marketing hype. They are a testament more to smart marketing than to smart investing. Whether Smart Beta strategies will perform well in the future depends crucially on the market valuations existing at the time the strategy is implemented. As noted above, value strategies performed extraordinarily well coming out of the internet bubble when technology, growth, stocks were priced richly relative to most value stocks. Similarly, small stocks did particularly well when they were inexpensively priced relative to large caps. Investors should be aware that if value and small size become richly priced, as Smart Beta funds become increasingly popular, the results are likely to be disappointing. No strategy is likely to be effective irrespective of valuation relationships. There is no reason to adjust the long-standing advice of the earlier editions of this book. The core of every portfolio should consist of low-cost, tax-efficient, broad-based index funds. If you do want to take a chance that some risk factor will generate excess returns in the future, you can do so most prudently if the core of your portfolio consists of capitalization-weighted broad-based index. Core of your portfolio consists of capitalization-weighted broad-based index funds. And if you do wish to add an additional risk factor to your portfolio, such as some extra exposure to small company stocks, you can do so most efficiently and effectively by purchasing a low-cost, capitalization-weighted fund that follows an index of small-cap stocks. Implications for believers in efficient markets. From March 2008 through March 2009, the stock market declined by almost 50%. Did the stock market reflect all available information in March 2008, and could anyone reasonably argue that stocks were efficiently priced? For many observers, the collapse of 2008-09 and the subsequent world financial crisis sounded the death knell for the efficient market hypothesis. In 2009, George Soros wrote that the efficient market hypothesis has been truly discredited by the crash of 2008. The EMH was blamed as the villain in the financial crisis and was written off for dead by countless financial commentators. For example, the respected market strategist Jeremy Grantham opined that the EMH is more or less directly responsible for the financial crisis. James Montier, global strategist at Société Générale, writing in the Financial Times, declared that the theory suggesting that markets are efficient was utter garbage and should be consigned to the dustbin. Some supporters of smart beta portfolios believe that markets are inefficient and see their portfolio construction methods as a way of protecting investors from bubble-priced stocks. Moreover, they argue that smarter portfolios can be formed by a reliance on academic findings that there are many statistically significant predictable patterns in the stock market. We have seen, however, that these patterns are not dependable in every period, and that some of the patterns based on fundamental valuation measures of individual stocks may simply reflect a better proxy for measuring risk. In addition, many of these patterns could self-destruct in the future, as many of them have already done. Indeed, this is the logical reason why one should be cautious not to overemphasize these anomalies and predictable patterns or to put too much reliance on smart beta portfolios to enhance investment performance. Smart beta portfolios will not protect you from market bubbles. I realize that some critics of the EMH and some managers of smart beta portfolios argue that the dot-com bubble was easy to identify as it was inflating. Robert Shiller published his book Irrational Exuberance in early 2000, just at the peak of the market. True, but the same models that identified a bubble in early 2000 also identified a vastly overpriced stock market in 1992, when low dividend yields and high price-earnings multiples suggested that long-run equity returns would be close to zero in the United States. In fact, from 1992 through 2013, annual stock market returns were over 9%, approximately their historical average. In December of 1996, when the former Federal Reserve Chairman Alan Greenspan gave his Irrational Exuberance speech, those same models predicted negative long-run equity returns. From the date of the chairman's speech through December 2013, the broad stock market indexes returned about 7.5% per year, even after withstanding two sharp bear markets. It is only in retrospect that we know that it was during 1999 and early 2000 when stock prices were too high. No one can help you time the markets so that you avoid being invested when the market reaches a temporary top. An exchange at an academic symposium between Robert Shiller, an economist who is sympathetic to the argument that stock prices are partially predictable and skeptical about market efficiency, and Richard Roll, an academic financial economist who was also a businessman managing billions of dollars of investment funds, is quite revealing. After Shiller stressed the importance of inefficiencies in the pricing of stocks, Roll responded as follows: I have personally tried to invest money, my clients' money and my own, in every single anomaly and predictive device that academics have dreamed up. I have attempted to exploit the so-called year-end anomalies and a whole variety of strategies supposedly documented by academic research. And I have yet to make a nickel on any of these supposed market inefficiencies. A true market inefficiency ought to be an exploitable opportunity. If there's nothing investors can exploit in a systematic way, time in and time out, then it's very hard to say that information is not being properly incorporated into stock prices. This lack of opportunities for extraordinary profits is often explained by a joke popular with professors of finance. A professor who espouses the EMH is walking along the street with a graduate student. The student spots a $100 bill lying on the ground and stoops to pick it up. "Don't bother to try to pick it up," says the professor. "If it was really a $100 bill, it wouldn't be there." Perhaps a better version of the story would be to remember that if any $100 bills are lying around, they will not be there for long. As long as there are stock markets, mistakes will be made by the collective judgment of investors. And undoubtedly, some market participants are demonstrably less than rational. But even if price setting was always determined by rational profit-maximizing investors, prices can never be correct. Suppose that stock prices are rationally determined as the discounted present value of all future cash flows. Future cash flows can only be estimated and are never known with certainty. There will always be errors in the forecasts of future sales and with certainty. There will always be errors in the forecasts of future sales and earnings. Moreover, equity risk premiums are unlikely to be stable over time. Prices are, therefore, likely to be wrong all the time. What the EMH implies is that we never can be sure whether they are too high or too low at any given time. Some portfolio managers may correctly determine when some prices are too high and others too low. But at other times such judgments will be in error. And in any event, the profits that will be attributable to correct judgments will not represent unexploited extraordinary returns that were obviously apparent. Pricing irregularities and predictable patterns in stock returns can appear over time and even persist for short periods. Andrew Lowe has argued that no engineer would ever devise a test to determine whether a particular motor was perfectly efficient. But engineers would attempt to measure the efficiency of that engine relative to a frictionless ideal. Similarly, it is unrealistic to require our financial markets to be perfectly efficient in order to accept the basic tenets of the EMH. Indeed, as Sanford Grossman and Joseph Stiglitz have argued, the perfect efficiency of our financial markets is an unrealizable ideal. Those traders who ensure that information is quickly reflected in market prices must be able, at least, to cover their costs. But it is reasonable to ask whether our financial markets are relatively efficient, and I believe that the evidence is very powerful that our markets come very close to the EMH ideal. Information does get reflected rapidly in security prices. The EMH's basic underlying notion that if there are obvious opportunities to earn excess risk-adjusted returns, people will flock to exploit them until they disappear is as reasonable and common sense as anything put forward by the EMH's critics. If any $100 bills are lying around, they will not be there for long. Capitalization-weighted indexing remains at the top of the class. In conclusion, capitalization-weighted indexing is unlikely to be deposed as the overwhelming favorite in the battle for index supremacy. Even if markets were inefficient, departing from the weightings given by the market as a whole would have to be a zero-sum game. All the stocks in the market must be held by someone. If some investors hold portfolios that do better than the market, it must follow that some other investors hold portfolios that do worse. Because of their greater costs, however, active management or smart indexing must be a negative-sum game. On average, these higher-cost portfolios must underperform capitalization-weighted index funds that can be purchased at close to zero cost. There is a remarkably large body of evidence suggesting that professional investment managers are not able to outperform index funds that simply buy and hold the broad stock market portfolio. 2/3 of professionally managed funds are regularly outperformed by a broad capitalization-weighted index fund with equivalent risk, and those that do appear to produce excess returns in one period are not likely to do so in the next. The record of professionals does not suggest that sufficient predictability exists in the stock market to produce exploitable arbitrage opportunities. The core of every portfolio should consist of low-cost, tax-efficient, broad-based index funds. If you do want to take a chance that some risk factor will generate excess returns in the future, you can do so most prudently if the core of your portfolio consists of capitalization-weighted broad-based index funds. Smart beta strategies are related to the multi-factor models discussed in Chapter 9. If one assumes that the beta of the capital asset pricing model is an incomplete measure of risk, the tilts or flavors listed above can be considered additional risk factors. By tilting the portfolio towards smaller companies, for example, the investor is making a bet that the risk premium that is available from smaller companies can enhance returns. Here, of course, smart beta is interpreted as a technique to enhance returns by assuming additional risk. Lowe has also argued that the existence of predictable stock market patterns is not an all-or-nothing condition, but rather one that can vary over time, depending on the characteristics of existing limits to arbitrage, market imperfections, and psychological biases. These factors can give rise to periods when stock returns appear to be predictable and departures from the efficient market hypothesis, EMH, appear to exist.